Until major regulatory changes occur, IRC 280E remains the biggest obstacle to profitability for cannabis operators. Because operators cannot deduct common operating expenses, they can often experience a tax rate up to 3 times higher than mainstream businesses. The good news is that with proactive tax planning and documentation, there are many ways cannabis cultivators can take deductions to minimize the impact of 280E. As cannabis accountants, we can help operators reduce the adverse taxation of Section 280E by analyzing cash flow, properly planning and documenting intentions. In the following, we'll walk through some key considerations and provide a side-by-side comparison of a sample of a profit and loss statement so you can see the impact of correctly allocating costs. Now, before we dive in, be sure to like, subscribe, and turn on notifications for more cannabis news and updates. The biggest challenge with 280E tax law is understanding how to maximize deductions for each vertical within their operations while minimizing their tax burden. Depending on how the cannabis entity is structured, the taxes are either paid by the company itself or passed through to the shareholders or members of the business to be reported and taxed on their personal income tax returns. Calculating your own business and personal tax returns can be complicated. Rapidly changing legislation and tax law require well-trained accountants specializing in the cannabis space. Operators who have filed their own returns often experience issues later on after an incorrect tax filing sparks an audit by the IRS. Adverse audit findings can cause monetary penalties, additional taxes owed, and additional fees associated with refiling incorrectly filed tax returns and audit findings. Some states, like Oregon and Colorado, do not include the 280E tax code for calculating state income taxes. Since cannabis businesses can be affected differently depending on which state they are organized in, it is crucial to obtain the advice of licensed professionals, especially if you operate out of multiple states or are unsure about the 280E tax law for your state. GreenGrowth CPAs operates nationwide in all states with legal cannabis adult use and has experience navigating 280E for all verticals. The key to navigating 280E is understanding cost of goods sold, or COGS. If a cannabis operator can prove that a business expense is necessary and directly related to growing the plant, then it can often be deducted. The goal is to allocate as many indirect costs as direct costs to be included in COGS, and thereby decreasing tax exposure for our cannabis clients. While COGS won't be recognized as expenses during the month the business actually paid for them, they will remain in inventory listed as an asset until the crop is sold. Once the sale is complete, then we move them into the cost of goods sold. This is known as applying the full absorption accounting method of inventory costing and can help a cannabis grower maintain accurate inventory. Through this analysis, we are able to create an inventory valuation for the balance sheet and still stay compliant with 280E. We have incorporated an example here of a profit and loss statement where we provided a side-by-side comparison for new client. A typical cultivation operations profit and loss statement would look similar to this example. The first column is a cannabis cultivation business not allocating indirect expenses under the cost of goods sold, while the second column is what happens to the same company when indirect allowable expenditures are deducted under the cost of goods sold. Here's some samples of deductible cannabis cultivation expenses. Soils, nutrients, clones, etc., all allowable as they are directly associated with cultivation. Management fees. We can allocate a portion of management fees to the cost of goods sold, as some pertain directly to the cultivation of the product. Rent. All rent can be allocated under the COGS if the entire site is used for cultivation, and there are no administrative offices. Security. All security costs are deductible as long as they are directly associated with cultivation. Utilities. Utility costs can be extremely high for growing operations. All utilities for the direct cultivation site can be allowable if the site is not used for anything else. Insurance. If business insurance covers the cultivation, then it's allowable. Technology. All costs associated with direct cultivation software. Depreciation. Assets are directly attributable to cultivation. Note that the second column indicates tax burden without deductions based on COGS, and the third column properly deducts costs in compliance with 280E. As you can see here, properly allocating deductions to COGS drastically impacts your bottom line. In this example, we allocated the cost of goods sold and increased the business's operating profits before tax by $197,500. Note that the information contained in this example is for discussion purposes only. For a true comparison of your cannabis business reporting methods, we recommend seeking out the advice of a tax professional. If a cannabis company is solely involved in growing and selling cannabis, most of its expenses can be deductible. When completing returns, it may be necessary to omit certain on-site offices, bathrooms, break rooms, etc. from the allocation based on their percentage of size and use. Determining the exact usage of the property is complex, and the help of a tax accountant can provide insight and prevent incorrect information on the filing. Out of the 4 main cannabis verticals, cultivators have the most opportunity to minimize their tax payment compared to the other 3, since most costs are directly relatable to the end product and are easier to prove. It becomes more cumbersome when the operation expands into other verticals or does not grow the plant itself. We continue to address deductions for the other verticals in separate articles and videos. Until the DEA and federal government remove marijuana from the Controlled Substance Act, cannabis will remain classified as a Schedule I drug, and operators can be considered traffickers under federal law regardless of their state's laws. While there has been some discussion to declassify cannabis from a Schedule I to a Schedule II drug, there remains a lot of controversy in this area, since substances listed as a Schedule II drug require the authorization of a physician. Once federal legalization goes into effect, the 280E rule will become obsolete in the cannabis industry, but until then, operators must continue to wade the waters of this unfolding market. For more information on navigating the 280E, reach out to our accounting experts at GreenGrowth. We are here to help you through any level of the tax filing process. We employ several financial programs that can assist your cannabis operation with its fiscal responsibilities, including tax planning and compliance, outsourced CFO support, audit preparation, tax controversy support, and much, much more. For recommendations and assistance with tax planning and 280E compliance, schedule a free consultation or contact us at 1-800-674-9050.